The American dream, for many, involves owning a home, but for many Americans, that dream feels increasingly out of reach. The housing market is in a state of flux, characterized by high prices and limited inventory. The cost of borrowing money, reflected in mortgage rates, has added another layer of complexity. The current state of the housing market is a tale of two realities. High prices and rising mortgage rates have made homeownership feel like an elusive goal. Enter the Federal Reserve, the central bank of the United States. The Fed plays a crucial role in shaping the economy. One of the Fed's primary tools is its ability to influence interest rates. Recently, the Fed has embarked on a series of rate cuts to stimulate the economy. Lower interest rates make it cheaper to borrow money, encouraging investment and job creation. In the housing market, lower mortgage rates aim to boost demand. For those struggling to enter the housing market, the Fed's rate cuts offer a glimmer of hope. Lower mortgage rates translate into lower monthly payments, making homeownership more attainable. This could be particularly beneficial for first-time buyers, who are often priced out of the market due to high down payments and monthly costs. Furthermore, lower rates could incentivize existing homeowners to consider selling their homes, potentially increasing the supply of homes for sale and providing more options for buyers. The potential benefits of rate cuts extend beyond affordability. Lower mortgage rates could also lead to increased competition among lenders, potentially resulting in more favorable loan terms for borrowers. This could manifest in the form of lower closing costs, reduced fees, or more flexible lending practices. In a market where buyers often feel like they have limited leverage, any advantage can make a significant difference. The hope is that these potential benefits will translate into a more balanced and accessible housing market, one where the dream of home ownership is within reach for a wider range of Americans. Section 4. Navigating the pitfalls, risks associated with rate cuts. While the potential benefits of rate cuts are enticing, it's crucial to acknowledge the associated risks. One concern is that lower rates could lead to increased demand without a corresponding increase in supply. This could create a situation where too many buyers are competing for too few homes, potentially driving prices even higher. Such a scenario would exacerbate affordability issues, particularly for those already struggling to enter the market. Another risk is that rate cuts could fuel a speculative bubble in the housing market. If investors sense an opportunity to capitalize on lower rates and rising prices, they may flood the market with cash, further inflating prices and creating an unsustainable boom. This is reminiscent of the housing bubble that burst in the mid-2000s, leading to a devastating foreclosure crisis. While the current market dynamics are different, the potential for a repeat performance cannot be ignored. Section 5, the double-edged sword, balancing affordability and competition. The Fed's rate cuts present a classic double-edged sword. On one hand, they offer the potential to make homes more affordable and stimulate the housing market. On the other hand, they carry the risk of fueling price increases and creating an unsustainable bubble. Navigating this delicate balance requires careful consideration and a nuanced understanding of the market's complexities. Ultimately, the success of these rate cuts will depend on a variety of factors, including the pace and magnitude of the cuts, the response of home buyers and sellers, and the overall health of the economy. It's a complex equation with no easy answers. Policymakers must carefully weigh the potential benefits against the inherent risks, striving to create a housing market that is both vibrant and sustainable. Section 6. A market in flux. Concluding thoughts on rate cuts and the housing market. The Fed's decision to cut interest rates has injected both hope and uncertainty into the housing market. While lower rates have the potential to improve affordability and stimulate demand, they also carry the risk of inflating prices and creating an unsustainable bubble. The ultimate outcome will depend on a complex interplay of factors, making it difficult to predict the long-term impact of these rate cuts. As we move forward, it's crucial to remain vigilant and informed. Potential home buyers should carefully assess their financial situation, considering both the potential benefits and risks of lower rates. Policymakers must continue to monitor the market closely, adapting their strategies as needed to ensure a stable and accessible housing market for all. The dream of homeownership is an integral part of the American fabric, and it's up to all of us to work towards a future where that dream is within reach for generations to come.